Okay. I think I'm live. Yep. Let's get this 5 minutes of fame out of the way so I can go right into the topic. 5 minutes of fame. Let me get that up. That's where you come in and drop your city and state, or you just simply say hello, right? Welcome to the live stream. Welcome to the live stream. So come in. Let me know if you all can hear me well. If everything's good. First person in, we got Martin from Detroit, aka Detroit. Michigan is in the house. Hello, Martin. I'm trying to go ahead and get this timer going because I'm going to cover a lot of topics. Specifically, what if I told you everything that you thought about mortgage and student loan debt is wrong, right? Will you take the red pill or the blue pill? So we got Martin from the 313 from Detroit is in the credit and cash flow room. We have Indianapolis, Lady Lou. From Indianapolis? Hello, in the credit. Hello, Philly. Yep, Philly is back in the building. Naturally gifted. Hello from Philly, right? Hello. West Philadelphia, born and raised. I'm playing with my daughter. Playgrounds where I spent most of my days. So, hey y'all from Houston, Texas. Y'all gotta put that southern accent in. We got Cheryl Lockwood. Hello, Cheryl. Thanks for tuning in. The credit and cash flow room. If you are new to my channel or new to my podcast, right, I am known as the queen of credit for the results that I help people get in the credit world, right? Let me try to just adjust this camera. I help people transition from bad credit to good credit, then from good credit to great credit, then help them to revision their credit to create more cash flow. So simply put, I help people make more money through credit, right? Using their credits to revision it to get assets over liabilities, right? And then adding a home-based business to their financial portfolio. Top Authority, hello from Arlington, Texas is in the credit and cash flow room. Hello, Top Authority. I have on my credit t-shirt tonight. Let me see what it says. Let me change my angle just a little bit. It says the good credit. I don't think you all can see it. Let me adjust it down. All right, the good credit lifestyle, just a shirt that I had, comfortable t-shirt that I had made. It says the good credit lifestyle. So we have Jesus in from the Philippines, aka California. Hope you are safe, Jesus, in these wild fires in California. Sandra, hello, Sandra from the Chi-Town. Chi-Town is in the house. Hello, Sandra from Chicago. Has first, I think he does. I think Martin already has that copy and paste, right? Yeah, he's okay. Thanks, son. He says she can hear me. Can hear me loud and clear. Thanks for the mic check. Right? How much time we got left? I stopped sharing my time. Okay, we got approximately 60 seconds. Hello, Eve from Washington State is in the credit and cash flow room as we have 55 seconds and counting for you to come in and get your 5 minutes of fame in, drop your city and state, or say hello, right? We have Mariah says I need to reach out to you this week. Yeah, that's fine. Mariah, that's perfectly okay. I just don't really respond to texts on Sundays, right? So yes, that'll be fine. Monday through Saturday from 9 o'clock my time, Central Standard Time, to approximately 5 o'clock. It's my office hours, or you can just visit my website, www.fixmycreditandcash.com, and send me a message there, right? JH says, hello, gorgeous. Hello to you, handsome. Don't know who you are, where you from, or your city or state, but thanks for that compliment. I always love to be called gorgeous as I'm playing with my daughter. Helena, South Carolina. Hello, Michael. Glad you came in and joined the podcast. Michael Marshall. And okay, Azu says he's fine. He's in the desert area, so just forget that background noise. There's cooking going on. And girl, boss plan, did I acknowledge you? Didn't want to miss you out from Washington State, right? From Washington State. So let's get into the topic of discussion. I want to share this with you, though. This is not in the title, as we have more people coming in. And as Jesus always remind my followers to do, right? Hit that like button if you are on YouTube watching, because it informs people that I am live, right? So YouTube loves that algorithm. So hit the like button because, I'm sharing life-changing information with you. I'm sharing knowledge with you that's going to impact and change your life financially. And the only price that I ask you to pay, right, is to hit the like button. Take out time if you're in the live chat to just exit out real quick and then hit the thumbs up, right? That's the price of admission, right? That's the price of admission. If you're on Facebook, hit the thumbs up and share this to your personal page on Facebook. And Nyla, hello to you, Queen. Hello. Our Periscope, show some digital love. Tap those hearts. Let's get those hearts going. Periscope loves that algorithm as well. And swipe right or invite and share with your followers, right? Just a little housekeeping. So this is an article that I saw as I was going live, but I did not haven't read it yet, but I did save it because I wanted to read it and share with you all. Let me type this in. All right, so let me type that in. And I can just add it as a banner. Thank you so much for that reminder, Zeus. Hello, Carissa from Mississippi, right? And we got Trey coming in from Edinburgh, Texas. And hello to you, Kim. Hello to you as well. So let's read this article together, right? Let's get educated together. It states, credit score or income, right? Credit score or income, which matters more when applying for a credit card. So I thought this was a cool article that we could discuss and read together. A FICO expert explains. You all do not know what the FICO expert is. A FICO expert, FICO is your true credit score. It's abbreviated for Fair Isaac Corporation. Two men, right, came together to create a model that would determine a scoring model that would determine if consumers were credit worthy, right? So I know Bill Isaac, Fair Isaac Corporation, is one of those men, and they came together and Fair, right? The other last name was Fair. I forgot his first name, but last name Fair Isaac, Bill Isaac came together. They created what we are known, or what you know as a FICO score, right? Now, if you have a free credit monitoring system like Credit Karma or Mint, right? They will use a Vantage 3.0 score, right? Vantage 3.0. So a Vantage score, simply explained, is not the credit score when you go to the banks, right? That your banks and lenders use if you're trying to get approved for a mortgage. if you're trying to get approved for a vehicle or if you're trying to get approved for a credit card. However, FICO scores, there are many FICO scores, right? It's not just one. You have FICO 9, right? FICO 9 score. And if you have a credit card, oftentimes with credit card, they will give you a free credit score, right? Every month that's affiliated with their credit card, or if you have like a Navy Federal or sometimes your banks. So read the fine print on those credit cards to see if it's a FICO 8 or FICO 9. FICO 8 is mostly used for vehicle approved financing and loans. FICO 9 is often, and some FICO 8s are used for credit cards as well. FICO 9 is used for most credit card lending. And then if you're trying to get approved for a mortgage, right, FICO scores 2, 3, and 5 are often used for mortgage approvals. And just know, depending on wherever your geographical location is, oftentimes depends on what credit agency will the banks use or the lenders use to determine if you'll get approved. For example, right? Some banks may pull from TransUnion. Some banks may pull from Equifax. Some banks may pull from both. Some banks may pull from all three. Whatever wherever you live, right? Whatever state you're in, that varies and changes. So let's go into this article. What matters more, your income or your credit score? So it goes on to read, whether you're applying for your first or fifth credit card, having a good credit score, something in the range of 661 to 780, open up doors to qualify for the best rewards and cashback cards for your purchases, right? Right now, in the economic situation that we're in with the economy, a lot of job losses, et cetera, right? Furloughs, laid off, reduced hours. You definitely want a good cashback credit card in your arsenal, right? Having credit cards that give you travel bonuses and benefits is not something that I highly recommend at this time, because you have so many airlines that are laying off. People are not traveling because of this health pandemic. And so you want to have a good cashback credit card because pricing on everyday goods and services are increasing daily. And you want to have these credit cards to help you combat those price increases. It's called inflation, right? It's called inflation. So if you get 1.5% or 3% cashback cards on all your purchases, it helps you in a sense of saving money and helps you fight the increasing of your things that you can't control: gas, groceries, daycares, beauticians, nailticians, et cetera, right? So during the approval process, the article reads, a healthy score can also help you receive the best terms and conditions, such as low variable interest rates and a higher credit limit, right? But what does your income stack up in comparison when you apply for a new credit card? So it says, let me share the article with you all so you can know for the people that's coming in. Some people say my video's in and out. Hold on, let me check. Let me know if it's still good or if it's still in and out, because everything is showing good on my end, right? So, all right, from Chicago, visiting Hamilton, Mississippi. I've never heard of Hamilton, Mississippi. So you all let me know how the internet is going in. And someone said still in and out. It's showing good on my end, on my reception. Okay, Walking Love says good. I don't know, maybe because, hello, Donald, one of my business partners. I don't know, we're having some bad weather on the coast of Mississippi, but that's not in my area. I don't know. It may be affected. Maybe we're getting the winds and things like that. may be affecting my internet, right? So let me try to switch this internet connection. Okay, some people are saying I'm good. All right. I don't know. I don't know. I'm showing all bars on my end. Okay, someone says I'm good. Some people still saying in and out, but it's showing good on my end. So, all right, let me continue to share this with you. So what's more important? A high credit cards? Okay, as you said, there is moments where it's cutting in and out. And maybe because we have high winds, right? In Mississippi, I think it's tropical storm, something start with an S. Kayla, what's the name of the tropical storm? You know?
Like my actual name?
Yeah, I don't know. All right.
Hey, Sarah.
Sarah, Sally, I don't know.
I don't care.
Okay. Cannon says YouTube. Hello, Cannon. Did an update 2 to 3 days ago on the app. I'm experiencing the same problem on my end on the live streams. Okay. So it may not be anything on my end because I'm showing great connection, right? So let's go back to the topic. Just bear with me and get the information as best as you can. So what matters more, your income or your credit score? The article goes on to read an analyst for FICO is that while your income still matters when applying for a credit card, in relation to your debts, it plays an important role when lenders decide your credit limit. So your income is a decision, even with a good credit score. Again, they said the range was between 661 and 780, right? When determining your credit limit. Because your salary shows how much you make and your debts show how much you owe, right? So that's good. The two factors combined give lenders an idea of how much of your capacity to repay what you borrow. Lenders then look at these factors to decide how much credit to extend to you. A borrower with a lower income threshold and a lot of debt will most likely receive a much smaller credit limit than someone with a higher income and less debt. Credit limits vary by card holders, but the upside of this is once you start building credit, you will have a better chance of getting more extended credit to you. Those borrowers will, with an already good credit mix, such as a mortgage, auto loans, or student loans, also have a great likelihood of receiving a higher credit limit on their first credit card versus someone with completely new credit. So this is some good information here. How to monitor your credit score. Since both your credit score and your income play a part in obtaining new credit cards, it's important to monitor both. I think me personally, Experian, as it lists here, has a free credit monitoring services. This is what I always recommend to my clients to have. And I like Credit Karma as well as a monitoring service because it will show you also Equifax and TransUnion, right? Equifax and TransUnion. However, they mention also CreditWise from Capital One. So I have not looked into CreditWise for Capital One. I'm not sure. Let me see if they show Equifax and TransUnion or all three. I have not signed up for it, but I will look into CreditWise because hey, if it's free, then why not do it, right? If it's free, then why not have those services? Because I have Credit Mint, Experian. I also have Credit Karma as well. So that's just a short article on how what will impact you the most, your income or your credit score. Again, the article states that your ideal credit score is definitely between a 661 according to the article and a 780, right? All right. Jesus says credit score, he's going to say credit score matters most. And I would somewhat agree with that, but we're in the FICO 10 era, right? We're in FICO 10 era, And the first phase of FICO 10, if you all are, well, I need my credit fixed. I see, so I'm just reading the comments. We're in the FICO 10 era, which means that the first phase of FICO 10, if you all don't know, FICO 10 is a newly updated algorithm to determine your credit worthiness, right? It takes into account how long you or how aggressively you pay down your debts within 2 years, right? A lot of people were getting a credit sweep, which would temporarily hide or disguise, right? Hide or disguise bad credit. It would temporarily remove bad credit for up to 30 days because the person or whoever would assist them with a credit sweep would have a claim that this person is a victim of identity theft. And while the investigation was going on to see if any of the accounts were reporting negatively as a result of someone stealing that person's identity, the credit agencies would temporarily remove those accounts. However, if after the investigation is complete and it was found that this person was not a victim of identity theft, right, then the accounts would be replaced back on. And so people would take this 30-day window and it would appear that no negatives are reporting, and they will go out and sometimes get financed for things like a vehicle, right? But then the next month or after the expiration of the 30 days or up to 45 days, their credit would be right back in the negative status that it was on. If they were not a victim, the credit agencies researched and found out that they were not a victim of identity theft and replaced those accounts and stated that, hey, these accounts were a result of your actions and no one stole your identity. Some people will pay up to thousands of dollars to get this credit sweep done, only to have to face that problem in a month or two, right? Lady Life, thank you so much, says Credit Wise uses Advantage 3.0 and credit information for TransUnion. Now, I did see some people on the YouTube channel that suggested that Credit Karma would not be using, or Equifax would not be a part of Credit Karma anymore. But as of today's date, September 13th, that is not the case, right? If Equifax or Equifax, however way you want to say it, whatever your dialect is, right, is still reporting on Credit Karma, right? Jesus said his Vantage score is 655 and FICO 8704 for the past 6 months. That's been true for a lot of my clients and also myself as well, right? If I look on Credit Karma, the Vantage score is showing lower, and that's with my daughter as well. And if I look on the Experian, the FICO 8 on the Experian for free is showing higher, right? So I prefer the FICO any day over the Vantage score. I'm not sure if the Vantage score, now you do know that Credit Karma, if you're using Credit Karma Vantage score, they were bought out. I can't think of the name of the company. And now they are calculating more debts, right? And trying to be in alignment with FICO 10. So I'm not sure if that's why Credit Karma, I think Intuit, that's who it is. Intuit purchased Credit Karma earlier this year in order to reflect more of the FICO 10 model, which heavily weighs in on your debt more. So I'm not sure if that's why many of the Vantage scores are showing lower than the FICO scores, right? All right, so hello, everyone coming in. So that's just a quick article I want to share with you all about, let's get into credit class, about what matters more, your income versus your credit score. However, I don't think I finished this sentence. If your debt ratio is really high, right? The first phase of FICO 10 is known as the resilience score. And so your resilience score matters because it will look at your not only your debt ratio within the previous 2 years, you see if you're aggressively paying down debts, which we will get into, specifically student loan debts, right? And it also shows the likelihood of you having income coming in, right? Of your job. Are you safety? Are you credit worthy? So Mark says he's humbly in the 800 clubs. Great, I got some good credit students in. So if you're watching this live and or on the replay, let's get into credit class, right? Let's get into credit class. I did a very short live stream requesting or asking that some of you all have your mortgage, if you're a home buyer, and or your student loan payment, right? So let's get first into credit cards. We're going to discuss the interest rates on mortgages, student loans, and credit cards. And I'm going to educate you and show you that the interest rates on a mortgage and student loan, and most time, is more deadly than the interest rate on a credit card, right? So let's first break down what is the APR on a credit card, right? Adjust this. What is the APR on a credit card? And I'm gonna be honest with you, I could really charge people to teach them this information. I could really make my YouTube channel where people would get a monthly subscription, right? A monthly subscription to pay to learn this, because this is very vital financial information for your financial future. And I don't see many thumbs up. So all I'm asking you to do now, if you get a super chats, great. I appreciate for supporting my time and the knowledge in the channel. But all I'm asking you all to do, whether you watch this live or in the replay, is to hit the thumbs up, support the channel, and that's the price of admission for now. Now, I may transition in the future to where I don't teach this without some type of monthly subscription payment or payment for this knowledge, right? Naturally Gifted says, I heard someone who fixes credit claim, they were able to remove student loan. I thought that was impossible. Any account that's reporting inaccurate, incomplete, or even unfair or unverifiable can be removed from your credit report. So if your student loan is reporting that way, if it's reporting inaccurately, maybe the balances are off, maybe the credit limits are not reporting correctly, maybe the accounting numbers are not reporting correctly, right? Everything on your credit report must be 100% accurate, right? Then they can get deleted off of your credit report. However, and this is usually the $1,000 question I get, most people misconstrue. They think that, okay, I've gotten a student loan, and I'm guilty of this early on, right? Me not understanding. I'm guilty of this myself. That if I get the student loan deleted off my credit report, right, that I no longer owe the student loan. And that's not true. Your credit report is nothing but a report card of your financial behavior, or how you repay any loans and any accounts. Do you pay time, or do you pay on time? Or are you a slow payer, right? Or are you a default payer? It has nothing to do with the company or the business that you owe. It is just your report card. So although your student loans may not be reporting on your credit report, you still owe that student loan. You still owe Navient. You still owe the U.S. Department of Ed, right? You still owe, I forgot whoever, you still owe the account. And if you default on that account, if it was removed for inaccuracy initially, it can be replaced back on there if you do not keep the account in good standing, right? Same thing goes with any other account, with the exception of credit cards. But even with the collection agency, right, you can get the collection removed from your credit report, but that does not stop that collection agency or that debt collector the right to subpoena you to court to sue you for the debt. And that's where debt validation comes into play, right? So sometimes in the credit repair process, right, a collection will be deleted, and then my clients will get a letter from the debt collector, and my clients think that I'm supposed to handle that as well, right? In the credit repair process, the credit agencies, Experian, Equifax, TransUnion will notify their debt, whether it's portfolio recovery, Midland funding, right? Whoever, right? That this customer is disputing this debt, and because we don't have verification on file, we're removing it from the credit report. And then that debt collector will then contact the customers in some cases and still request the payment because the customer does not know how to request proper debt validation to properly eradicate the debt or discharge the debt in which they do not owe. So Mariah J, thank you, Queen, for the $5 super chat. I do appreciate that. Will Higgs, thank you so much. The $2.99 super sticker. Is showing a super sticker. That's cool. Thank you so much, you all, for getting those super chats and supporting the knowledge, right? Because knowledge is not power. It's not, applied knowledge is power. But you first have to get the knowledge. So let's break down what is credit card APR. And let me see how well you all can see this, because I will be using, if my nails can allow me to take this out. Credit card APR. All right, APR abbreviated for annual percentage rate, right? Annual percentage rate. So being aware of your annual percentage rate when you're paying on a debt is crucial, so you can prioritize the big picture of your financial life, right? So getting rid of your debt from the lowest to the lowest interest rate allow you to eliminate the most significant interest expense that's in your budget, right? So let me repeat that again. Getting rid of your debt in the order of the highest to the lowest interest rate would allow you to eliminate the significant interest expense in your budget. But a lot of people don't know what their highest interest rate debts are. Most people look at the numbers and they automatically assume that you're paying the highest interest out in credit card debt. And I'm going to show you tonight that is oftentimes not the case. Even though your mortgage and student loan debts can show a single digit, right, 3% or 5%, that is still often your biggest interest payments that most people will ever encounter, right? So let's say, for example, if you had a credit card with a 24% APR, okay, I hope no one has a credit card this high, but let's say you do. Now, months vary in length when it comes to credit card and how interest rate is applied. So you have short months like February that give you 20 plus days, right? Then you have months that give you 30 days and months that give you 31 days, right? So credit cards, you can break down your APR, your annual percentage rate, even further into a daily periodic rate. It's called DPR, daily periodic rate. So DPR, daily all right, so that's your DPR, your daily periodic rate. You divide this, your DPR and your APR by 365, right? Because you have 365 days out of the year. So you want to know what your daily interest rate is being calculated on a credit card debt, right? So if you have a 24% annual percentage rate, you divide it by your daily periodic rate, that will come out to be 0.65%. And I'm gonna be honest with you, I hated math in school. I hated math in school. They would have taught it like this, I probably would have appreciated more because it's more real life. But I can do it when it comes to credit cards and mortgage and interest rate and I love to teach it in that fashion or that faucet, right? So the formula for your credit card bills is the daily rate multiplied by your daily credit card balance, right? So you have the daily rate and you multiply this by your daily balance. All right, you multiply this by your daily balance. And then when that number is multiplied, right, then you also multiply by the number of days in the monthly billing cycle, right? So your daily rate multiplied by your daily balance, and then you multiply that by the number of days of your monthly billing cycle. Remember I said earlier, every month have different days within the month, some 30, some 31, some 28. So it's important to note that you're only charged on the APR on the credit card charges when you carry a balance from month to month. This is why I love credit cards. So let me type this in. You only, if you pay the full balance, right, every statement date, you can avoid all interest charges, right? Let me say this again. You're only charged on the APR on a credit card when you carry a balance from month to month. Okay, I'm coming back in. I'm sorry, I got my back turned. Thank you all so much. Jesus for the $1.99 super sticker. Thank you so much, my king. Jesus always have my back. I appreciate that. Martin is saying this is important information. Let's continue to support our channel, Make Finance. Thank you so much, Martin. Trying to see. Let me read my other comments as I put this in the statement because I want you all to be able to. So I have it at the bottom. It's strolling down at the bottom. Use my credit card to buy rental property. Get your credit right, ladies and gentlemen. It's easy as hell. I use my credit card to buy rental properties as well. I love credit cards for their purposes because credit cards and oftentimes will only be the lines of credit that give you a 0% interest rate for up to 12 to 18 months. So that gives you 12 to 18 months of free interest in which you can, or no interest rather, in which you can liquidate. Liquidate means to convert into cash that money and invest in real estate, and it gives you 12 to 18 months, people, at zero interest, right? In which you have an opportunity to erase or eradicate that debt. Thank you so much, Jaw Drop. He said great content. Ready to pay. Are you Mr. Willer on IG, Instagram? I know I have, and I do. I'm not on Instagram as much. I do, go in 2 or 3 times a week to check my messages, but I'm not on Instagram as much as I should. And so, are you Mr. Willer? I know a Willer, and I remember that name on Instagram. Message me because my classmate name was Willer, so that stood out. And yes, and thank you everyone for their contribution. So Jesus is absolutely correct. Each bank has its own billing cycle, people. So that's why it's important to know these 2 things, right? And I'm trying to make sure that this is not. Let me push this down. It's important to know, looks a little blurry, but just your statement date on your credit card, Important to know your statement dates and your minimum payment due date. Now, this is my method, right? This is my method. Thank you, Bathaholic. Thank you so much, y'all, for the super chats coming in and super stickers for the $4.99 super chat. Thank you all so much. I appreciate you supporting the channel and the knowledge. It's important to know your statement dates because your statement date informs you of two things. Number one, when your credit card will report the balance. When your bank, will report the balance of the credit card, right, to the credit agencies, Equifax, TransUnion, and Experian. This is one reason why I do love Credit Karma, right? Because it will show you the reporting date in which your credit card reports to the credit agencies, right? Credit Karma is really good at showing you the reporting date in the statement reporting date, right? So why is that important, Queen? Because the lower your balances when it's reported to the credit agencies, the higher your score, right? The lower your balances, the higher your score. So you want the low balance on the statement date. Number two, why the statement date is important is because this is your billing cycle dates. You want the statement dates, you want the begin date, statement date, and you want the end date. Now, this can be, for some credit cards, it can be from 50 to 57 days, right? That means that you have this length of time when no interest is occurred. And from some credit cards, it can be from 20 to 25 days. Or it can be from 55 to 57 days on other credit cards. So it's great for you to call your credit cards and to ask them, what is my statement begin date and end date? Because this is your time frame where no interest can be charged if you pay the account off in full. So let me reiterate and reemphasize, it does not matter what your APR is. The only way you are charged interest on a credit card is if you carry a balance from month to month. If you pay off the balance in full by the statement due date, notice I said statement due date, people, right? This is called your grace period. Let me put this in. Grace period. So if you find out that your statement dates are before your minimum payment due, you can call and request that your minimum payment due be moved to a later date, right? Or, like for example, let's say your statement date is the 2nd of every month. Your minimum payment due is not due to the 5th, right? Well, the 2nd is when the banks from their credit card holder reports to the credit agencies. So this is the time that you want to carry the lowest balance. Now, your grace period is still in effect for both of them, but in order to keep and maintain a high credit score, it's important that you pay, right, the lowest amount of balance that you can during the statement reporting days. However, some people push or they request that their due dates on their credit cards, in order to really fully utilize this strategy and not getting caught up of having late payments assessed to them and late fees, is they requested their balance due date, and you all can do this, a lot of people don't know this, be moved to a later date. For example, all of my credit cards, all of them, my balance due date is the 28th of every month, but I pay them on the statement days, right? Thank you so much, Queen. Thank you so much. So these are just some real nuggets that I'm teaching you all. You don't learn this stuff in school. And so for the people that are supporting with the super chat, I thank you, because you can pay up to hundreds of thousands of dollars to be in a conference for people to teach you this same information, right? So let's say, for instance, you go out, you make a purchase on September 1st, maybe a new boots or whatever. I don't recommend buying things with your credit cards. I recommend buying assets. But let's say you go out and purchase a new pair of boots, right? On September 1st. Your credit card bill isn't due to September the 21st. You can delay the payment for 20 days, right? If you pay off your entire credit card bill, right, then those boots that you purchase isn't subject to APR. So what I mean by that is, if you purchase the boot September 1st, but your bill isn't due until March 21st, right? You have a 20-day grace period that if you pay that balance off in full, you will not be subject, or you will not be charged the APR or your annual percentage rate. So there's a different types of credit card interest rates. You have the introductory rate, right, on a credit card. I have a lot of those 0%. Promotional, right? APR, your annual percentage rate, is lowered for a limited time. Just know, if you have a introductory rate, however, and let's say 0% for 12 months, right? And you don't pay that full balance off within that 12 months period, it will go back and recur and recalculate all of that interest. So if you are using introductory rate credit cards, you definitely want to make sure that you pay the balance off in full before that promotional time period ends. Right, you're right. A great tool, you might not get your accurate credit score, but it offers so much other and free monitoring system, and lets you know your statement reporting dates as well. Now, another type of interest rate you may have on a credit card is called a purchase, right? APR. It's the rate applied when you make a new purchase on a card. This is the one I hate the most because it's usually the highest, right? But it's called a cash advance APR. It's the rate for using a card to withdraw cash from a bank or ATM. It's typically higher than your annual percentage rates. I don't use cash APR, but what I do with my credit cards that I have balance transfer checks with, if I needed cash, I will write the checks out, pay in order to myself, right? Write my name on the line, sign it for the cash amount, and then I can get that at 0% interest rate versus using your cash advance option, right? And then you have a balance transfer APR. That's the rate applied when you move an existing debt into another credit account to a different card. So in other words, you're transferring debts from a card or a loan. You can also do this on some personal loans to a lower rate card. And that's an excellent strategy as well to eliminate debt faster. So a lot of times when you hear Dave Ramsey and other people discuss, right, cutting up credit cards, before you cut up your credit cards, I would highly recommend this option of repairing and restoring and rebuilding your credit. And you can possibly get those high interest rates transferred to lower interest rates, which means that you can get rid of that bad debt or high interest rate debt at a higher pace, right? At a higher pace. And then you have something called a penalty APR, which I don't want any one of you all to get. Your penalty APR is the rate applied to your card when you violate your agreement by not making your payments on time, right? After you be delinquent for about 60 days, the issuer of the card can issue up to 35% annual percentage rate on your existing balance. And that's so true too when you're using the balance transfer method, right? You don't want to not pay and you've got a 0% balance transfer. And then if you're a delinquent or you're late, they can double the interest up to 35% in those cases. Or if you're just late paying for 60 days, it's 2 consecutive months, right? Then you also can get an increase of an interest rate. So just know when it comes to credit card, your monthly loan payment is based on how much you borrow, right? And the daily interest, right? And so the APR on mortgages and auto loans is different than how it applies to credit cards, right? With credit cards, you typically don't have additional charges. And other than maybe some people may have annual fees that may come out, but you also can get rewards. So the APR for a credit card is usually the same as its interest rates, if that makes sense. But I'm going to say this again, I have it strolling down to the bottom. If you pay your credit cards in full every month, the balance out, you are not charged interest on that amount. So that's why I request that people do this. All right, so let's get into the meat and potatoes. Let's break down mortgage loans, right? That's it for credit cards. AR says he's late. Well, AR, you coming right in, kind of in the velocity banking session. This is a breakdown of credit card APR, and I want people to really understand what's strolling at the bottom of this live stream, right? You're only charged APR, or interest on the credit card, when you carry balances, right? I don't care how bad your credit was when you got the credit card. I don't care what the interest rate terms is. If you do not carry a balance, people, you get no charges, no interest charges. And that's why I love credit cards. And that's why I inform people to try to only charge the amount that you can pay off in full every month. So you do not get those interests. You do not get those interest fees. So which one do I want to share? Let's get into 30-year mortgage rates, right? Let's get into 30-year mortgage rate. We know that 30-year mortgage rates today are lowest that they've been in decades, lowest they've been in a long time, right? And because of this, a lot of people want to take advantage of 30-year fixed interest rates. The average for 30-year fixed right now is like 3.5%. It's dirt cheap, right? Just a month ago, the interest rate on the mortgage was like 3.21%. So you're saving some points. However, I want you to know that even at a 3.5% interest rate on a mortgage loan, let's say it's a 30-year fixed interest, for every $100,000 that you borrow, you're going to pay approximately, people, and this is why I took our time to teach this tonight. You're going to pay approximately $424 and about 31 cents, even at a 3.5% rate, monthly. So you remember what I just told you about credit cards, interest rates, right? You know what I told you about calculating the daily periodic rate and the annual percentage rate, and that credit cards will only charge you the balance that you incurred from that statement date and statement period. That's not how it works, people, with mortgages. Let me move this over some. Okay. Make sure you all can see this. That's not how it works with mortgages, people. I know people look at it, they bash credit cards. As I sip my tea, you see the pool in the background. I wish I was on the pool. They bash credit cards so hard. Oh man, they really come down on credit cards. Now, one thing I can say about Dave Ramsey, now he's not prejudiced, he's not biased. He talks about mortgage, student loans, all of that. He don't want you to have the debt, but he gonna give you a solution to build your cash flow so you can afford these houses, right? So you can afford to pay cash for a dependable vehicle. And his only solution of increasing your cash flow is to get a second job. And I hate that solution of getting a second job because it doesn't teach you how to earn passive income, right? Which means that people that have jobs are taxed the highest, right? That's why the rich never work for money. And when you're taxed the highest, what that means is you only earn about 60 to 70% on the dollar that you're working for. No, Jesus, we might get married one day. I think Jesus know me so well. This is just straight unsweet tea. I went to a Ghetto Taco Bell, and Sonic in Mississippi has the unsweet strawberry, but the Ghetto Taco Bell just had unsweet. They didn't have strawberry mixture in it. I hear up north though. Was it Iowa or Idaho? One of them, they said they don't even do sweet tea. You just get unsweet flavored tea. So that's the tea I love, but I just had to get unsweet tea. And so even at a 3.5%, I know that looks like a 305. Let me make this. For every $100,000 you borrow, you're going to pay approximately $424.31 in the interest every month. Now, do someone on this live stream have their mortgage with them? Because I can break it down to you, right? I can break it down to you, and I can also show you that how credit cards, it's called velocity banking, can be used to pay less interest, right, on any mortgage debt. So this is what happened with mortgages. And it's looking blurry. Okay, now it's clearing up. This is what happened with mortgages, right? Amortization. Nyla says, exactly, Curtis. A job is hustling backwards. It is. Geocycle, she should have been more likes this video than 56. Then thank you so much. You all get those likes up. And Nyla says she needs to join my program. Actually, Nyla, I don't have a program for this. I really don't. I keep saying I need to create a program. I need to write my book. But people, every time that I try to, I get so on. I would really have to tell people for a month that I'm not doing credit repair. I get so overwhelmed with people that sign up for clients for credit repair that, sometimes I find myself lacking time to actually create programs to teach this. So this is what happens in a mortgage. You pay your escrow, which is a combination of your property taxes for the home or your county taxes, and then you have your insurance, right? You have to have your homeowner's insurance. In addition to, some people through FHA loan have to pay a PMI insurance. It's called a private mortgage insurance. Now, I purchased the home that I'm in 2008. So in 2008, once I got the balance of the loan at a certain threshold, right, the private mortgage insurance was eradicated. It was gone. However, people that got FHA loans, I think, I can't, because I know you all, but this stuff I'm teaching is right off the dome. It's right off my head. But it was a FHA loan. Somebody do their research for me. They stopped giving you the options of being able to get out of your PMI. It may have been 2015 or 2010. I'm not sure. So you had two types of insurances tied into your mortgage. You had private mortgage insurance if you went through FHA. If you did a conventional loan, you didn't have to worry about this, right? And then you had your personal insurance. So one of the things that I did, one of the chess moves that I made is when I got my credit score to the highest it's ever been, right? And during my divorce, I was awarded the house. So when my credit score hit an 823, I called and got a second quote on my homeowner's insurance. Because what a lot of people don't know is that your insurance on your vehicles and your house is all dependent on your credit score, right? It's all dependent on your credit score. And so when I did this and got a second statement for my homeowner's insurance, I saved $1,000. It was $1,000 plus on my homeowner's insurance that took away from my escrow payments. So that took away approximately $100 that I was paying every month into escrow that calculated into my mortgage, right? Restructuring, this is chess is not checkers, higher credit score, lower insurance payments on your vehicles in your house, right? Even if you're renting an apartment or a condo, you have to have the insurance. So this saved me $100, approximately $100 a month of additional cash flow. So then when my balance got to under, I think 140,000, this PMI was eradicated. Private mortgage insurance because it was FHA loan. So this was saving approximately $200 plus in cash flow. See, that's why the name of the game with me is always credit and cash flow. If it wasn't for my credit, this would not have increased my monthly cash flow, right? Because again, the credit score helped me to get a cheaper homeowner's insurance. Now, the county and property taxes is nothing I can do about, right? But at this point, it was about, I think $300 now. My mortgage where it was close to $500, right? So this saved me $200 of cash flow. So now what do you do if you're paying $400 or $500 in the interest? And a lot of people don't want to even look at their mortgage. They want to be, they don't want to look at their mortgage statement. Look at your mortgage statements. Look at your mortgage statement. It should break down on that mortgage how much you're paying in interest and how much you're paying in principal. Jesus says, thank you, Jesus. FHA, you can't get rid of PMI unless you pay off the mortgage or when you have 20% equity. Well, now when I got my loan, that wasn't the case. They just changed those rules. I think, I don't know how long ago it was, but my mortgage was that was not the case. I was able to get rid of the PMI when I got my equity down on the loan. But for some new people who are using FHA, right, they can't do it, right? They cannot do that now because the rules have changed. Thank you, Mark. But just know, people, my credit score fluctuates because I use credit to invest, right? If I have an 823 and if I have money available on my credit card to invest with, whether it's real estate or whether it's assets, crypto, or coins, gold and silver, that's what I use my credit score for. I don't have an 823 credit score to brag and say I'm in the 800 club and all I have is houses and all I have is a liability. I use my credit score to invest, right? Not to spend. Big difference. So it was an 823 at the time, and I said, okay, I have an 823. What are some strategies I can use? For this, it helps me free up cash flow from my escrow, right? A lot of people don't know this. They don't know that they may be paying $2,000, $3,000, $4,000 in insurance. If they improve their credit score, they can drastically drop that, which will drop their escrow payments. So then, let's say if you have a $1,000 payment or $1,200, which is considerably low, you're paying $424 interest. I just gave you stretch to drop this, but you're probably going to pay an additional $400 plus an escrow, which is again a combination of property taxes and your homeowner's insurance. So then you own, let's say this is a $1,270 loan, right? So now you have $400 that's only going towards your principal. And what is principal, people? Principal is the amount to borrow. So this is how they calculate, or the calculation of interest is determined on your home mortgage. You take the principal balance, the amount you borrow, you multiply that times the interest rate. Now for me, my interest rate is 3.75%, right? But if it's someone else, let's say someone else did get that 3%, they're at 3%. So you'll do a 0.03. You multiply whatever your balance is, 200,000, 300,000, et cetera, right? That's how you calculate. And you divide that by 12. And this is how you can calculate your monthly interest. Your monthly interest rate. And so when you get a mortgage, it's not like credit cards that you only charge interest on the balance, or you have the option or opportunity to not be charged interest at all. When you get a mortgage, that interest is front loaded and calculated in the beginning in your payment. So what are you telling me, Queen? What do you mean? That it's harder for you to really pay out the amount, that's the true amount that you borrowed, when only 1/3 of your mortgage payment is going towards the principal. The other third is going to escrow, and your other third is going to interest, right? This is your principal. Let's say you borrowed $250,000. This is your principal on the loan. But then all of this is your escrow and your interest. This is the fat of the loan. So let's say 250,000, get my calculator, times 3%, which it should be 15. Carry your 1, 3 times 2 is 6. That'll be $750,000 to pay back, right? 0.3%. So how does credit cards stop you from paying back on a 30-year mortgage at 3% on a $250,000 loan, $750,000 total back? See, because a credit card has what we call simple interest, and amortization interest is interest that's front loaded in the loan. That's how credit card and mortgages sucker you in, right? That's how they get you, because you're looking at the interest rate, but you're not looking at, right, the total interest that you're paying and how you have to pay that interest back. See, your interest rates are fees that lenders charge so they can make more money on loans, right? So when you repay your loans back each month, or your debt back, the money that goes towards eating up this interest that's canceled around the amount you owe, they already front loaded. It's not like that with credit cards. Again, the principal is the actual amount of money that you borrowed, right? And so with a credit card, when you get your bill every month, that interest is broken down separately and is only charged on the balance, right? And so this is why this is so important. I'm going to show you how this works with credit cards as well. How this works and how credit cards are front-loaded amortization with the interest at the front of the loan. So it's easy to see that this works over time. It's called compound and daily interest too, right? So you make little headway towards the bullseye or towards your actual principal every month, even though your payments remain the same, right? You are making little impact, little headway on your principal every month, even though your payment remains the same. And this is called amortization. Amortization. Let me put this in the comments so you all can know. It's called amortization. And I think I can stop putting it. And you want to know who's stealing your wealth? This is how your wealth is stolen. This is how your wealth is stolen. See, a third of your check goes, or your payment goes in interest. Thank you, AR. Thank you so much. Then a third goes to the escrow. You never know when you can't control your property taxes, but you can control your homeowner's insurance with good credit. And then the other third of it goes to the actual amount that you borrow. Credit card is not calculated this way. So what velocity banking teaches is to either get a credit card with simple interest or a HELOC and apply towards the principal payment of your mortgage. So if you use this strategy, you have to let them know that I want to make a principal payment. Because the lower your principal payment becomes, right, or the lower the principal balance or the original amount you borrowed, is the only way to decrease that monthly and daily interest that they already calculated in from the beginning of the loan. And see, this is why I don't envy people, right, that may have six-figure paying jobs, but they don't have this education. They don't know this. And they're going to pay back double the amount of a loan that they borrow in a house note. So I'm not really teaching how to do this. I'm teaching you the overview. But what you have to do, if you have a credit card, maybe you have a $25,000 credit card, or maybe you can take out a HELOC. A HELOC is for home equity line of credit, right? Loan against your house. So you can use your house to pay for your house, right? You can turn the banks against one another. For example, I have a Chase rewards card, Freedom Card. I use my 0% interest on the credit cards, and I pay my Chase mortgage card with it. Both of them are Chase banks, but one is simple interest and one is amortization or compound interest. Exactly, Jesus. He said the first 20 years you're throwing pebbles. Your next 21 to 25 years you're throwing rocks. And then years 26, and you know what happens in years 26 and 30? People are ready to retire if they stay in it that long. And then the houses need so much maintenance and fix-up work, they go take out another mortgage loan or equity loan because the house has depreciated so far, right? Because they stayed into this trap for 30 years or even 15 years. And now they got to take out a loan against the house to fix the house up again. And then they recycle and repeat this all over again. When if you have equity in the house, thank you so much. You can take out a line of credit Now, I will tell you this about a HELOC. Now, we are in a recession. We're in a recession. And so the only thing about a HELOC is that it's adjustable rate, meaning that at any time the banks can increase your interest rates. It's not a fix. That usually won't happen with a credit card unless you're in default. But usually people can get more money. But HELOCs are very low right now because, the rates are still low for mortgages and HELOCs. So because most people can get approved for more if they have the equity in their home for a HELOC quicker, right? So example, if I had a $50,000 HELOC, I wouldn't take the entire $50,000 and dump it on the principal. I would take about $10,000 at a time and dump it on the principal, pay that $10,000 off, because a HELOC is just like a credit card. It's revolving debt. You can recycle and reuse it. Once you pull the money out and pay it down, you can reuse it again. I love credit cards and lines of credit, certain lines of credit, right? Some people also use just business lines of credit, right? Business lines of credit. And so what you do then is use your credit card or your HELOC or business, just a LOC line, another line of credit, right? Okay, Lady Lou says HELOCs are not being offered by Wells Fargo or Chase. I had one on my local bank. I paid it off, right? So maybe some local smaller banks will offer that. But people, what you have to do, and I'm not trying to just get in depth with this, but then you have to, for example, if you use a credit card, it's let's say you have a $25,000 credit card, it's so hot. You have a $25,000 credit card, right? Line of credit. What you want to do is dump your paycheck into this credit card and use the credit card for everything. Now, I personally would prefer a credit card because I can get rewards for it, right? But you don't want to max that credit card out because you want to pay all bills that you can pay with the credit card, especially if it's a good cashback rewards card. And you want to, make your groceries because food prices are increasing with your credit cards, right? And so you dump your entire paycheck in this and you pay it towards the principal. And every time you make a deposit into the paycheck, it counts as a payment and it pays the debt down faster. Now, you may be saying, Queen, how can I make a deposit into my credit card? This is how you do it. When your check, right, hits your bank as a direct deposit or your passive income or your business income, you then transfer that money to all of it to the payment of the credit card. Now, your monthly payment on your house will be due. And oftentimes, most mortgages do not accept credit cards for monthly payment. So you may have, let's say your monthly payment for this mortgage is $1,280, right? Then you will have to keep $1,280 out to make your mortgage payment and pay everything else with credit cards that you can. You can pay your light bill with credit cards. They may charge you a small convenience fee, but it's worth it because you'll get the rewards points. You'll get that money back. Light bill, internet bill, whatever bills. But whatever bills you cannot pay on the credit card, you leave it in the banking account and pay it that way. Now, this is where the home-based business comes into play. Some people need the extra cash flow and they want money back for paying their bills, for making groceries, for their children. You all know we're going into remote schooling and virtual learning. And a lot of times people have the money right in their paychecks, or they can get a paycheck pay raise is what I call them. And hold on just a second, let me fix this. All right, give yourself a paycheck pay raise through the home-based business. And then when you do that, Some people can get up to, on the low end, $200 to almost $800 more out of their paycheck, right? Because now you have a home-based business, you get more business tax deductions, and that extra cash flow really help the velocity banking method works to save you thousands and years, right, off of your mortgage, which will position you to pay that mortgage off in 5 to 7 years, right? So let's go to the last one because I'm getting tired. How is student loan interest calculated? Again, the thing to remember about interest when it comes to student loans and mortgages, the interest is recalculated or compound, right? The interest is recalculated and compound. Let me put this in. Okay. And people, that's why I tell you all your credit matters. In order to qualify for these HELOCs and things, you have to have a good credit in order to get your insurance dropped on your vehicles or your house, right? You have to have good credit. Good credit is the foundation to all of this. So recalculated means compounded interest, and many student loans are compounded daily. So when you have a mortgage, it's already calculating the monthly payment. Student loans are compounded daily. Unlike a credit card where you don't have to pay interest if you pay the balance off in full. Right, it's really, I teach people debt elimination, cash flow, and credit all in one. This is the real debt snowball, not working 2 jobs, right? And I teach people debt elimination versus making a single payment on your mortgage that won't put a dent. Did you all see that interest that was surrounding that principal? Making an extra payment won't put a dent in it. It won't save you the years or the thousands of dollars in interest. If I would have broke down the thousands of dollars in interest that one lump sum payment of $10,000 mortgage make, people will be running to get this done. So I teach debt elimination, cash flow, and credit strategies all in one. For a real debt snowball, where people are not hustling backwards and trying to work 2 jobs and they're still getting less take-home pay, right? Thank you so much, Tracy. I love my scope on Periscope as well. And so people that you can get the most out of your labor, the most out of your paycheck, and the most out of your credit. AR says, oh my God, this is why I love having people like AR and Jesus and Martin, everybody on that comments and help me educate and teach. It makes it so much easier for me. A $112,000 payment on the principal of a $750,000 loan at 3% on the first month. People, see, numbers don't lie. Numbers don't lie. Men lie. Women lie. But numbers don't lie. You, I'm so hot. I'm looking for my, hold on, I gotta get a Band-Aid or something. To pull this Mississippi Herald. Thanks so much. A one-time payment. See, you're talking about getting 2 jobs and making an extra payment. People, I'm talking about, as Jesus says, we're not throwing rocks in bad debt. We're throwing stones. I'm not teaching you all to shoot bullets. I'm teaching you all to shoot bombs and grenades. We're not playing with this, right? I'm not playing with your labor. I'm not playing with your job. I'm not playing with your mental health, your financial health, right? I'm not playing with you being a slave to debt and afraid to use credit. Let me say that again, because sometimes I say some stuff impromptu and it be so good, I need to repeat it. I watch my own videos and get inspired, right? So I can watch this replay. I'm not teaching people to be enslaved to debt and afraid to use credit. Debt elimination, cash flow, and credit strategies all in one, right? So look at the numbers. At one time, if you only did this one time and you had, according to AR, a $750,000 loan at 3%, people $144,802 in interest. So can you imagine how many years that you're saving yourself? How many years of a mortgage? It's so sad that when people finally pay their mortgage off, their house has depreciated so much that they almost have to rebuild it to make it livable. The roof has to be fixed. We need to change out the carpet, change this out. Let's remodel this room. You're not even happy with it anymore by the time you pay it off in 15, 30 years. And that's why Grant Cardone made the argument that, you know what, some people should not even buy houses. You should lease or rent houses, but you should also use that as tax deduction payments. And see, when you're leasing and renting and you don't have a home-based business, you're losing out on so many deductions so you can get your money back. If you want to lease versus buy, that's fine. It's just like with a vehicle, right? No, it saves you this over the lifetime of the loan, right? You'll save, if you had according to AR, did this one time, a $12,000 lump sum payment has to be lump sum towards the principal, right? At 3%, $144,802 in interest. I do have an Excel worksheet, but it's on another one of my laptop. It would have broke down the years too, you know. James said, Queen, what about when someone pay half their mortgage at first of the month, then the second half in the middle of the month, 30 years? I've heard that, and it's, kind of bi-weekly payments, but that does not eradicate. See, the interest is already calculated in. The concept of that is that your mortgage is accumulating compound or daily interest. That won't really be effective until you get the cancer of the loan, and that's the principal. Because unlike many people have taught, your mortgage is not calculated daily interest like your student loan is. I'm going to show you that in a minute, but not your mortgage. Your mortgage is calculated by the year based off the principal balance, right? So you have to be effective with this and paying a mortgage off in 5 to 10 years, you have to make lump sum payments towards the principal, right? Towards the principal. So let's get into student loans for my voice and my mind stopped working. So how is student loan calculated? Let's say you have a $10,000 student loan. $10,000 at 5% interest. Now you do know there are two types of student loans. And let me look this up because that's the one I don't know right off the top of my head. Unsubsidized. I think unsubsidized is calculated. Occurs interest or draw interest that start occurring interest as soon as the loan is dispersed. So let's say you're a freshman in college and you get a $10,000 unsubsidized student loan. As soon as you get that loan, it starts occurring interest or gaining interest from that day. It's a fixed interest rate loan, right? A fixed interest rate loan, and students are not required to start making payments in while in school. So you will want to get a subsidized loan. Let me put this in. A subsidized loan, because they won't start occurring interest until you graduate. And I'm teaching some college students actually Wednesday about credit, and this is some of the things I'm going to go over with them. A girls basketball team, Jackson State University women's basketball team. I'm having a Zoom training with them about credit and athletes. I'm glad that coach had the vision. So this is where my basketball and coaching comes into play with credit and cash flow and financial. So I get so excited when I start teaching a younger generation, right? Because I want to let them know early. So make sure that if you're going to get a student loan, you know if it's unsubsidized or subsidized, right? Because if it's unsubsidized, that very day you get it, from the freshman year to your senior year or sophomore, junior, it's going to start accumulating interest. With a subsidized loan, it doesn't start until after your college career is completed. So you much rather want to get subsidized, right? No problem. It's never too late. It's never too late to start putting in the knowledge, right? You don't know what you don't know until you don't know. So let's say you get a $2,000 student loan at 5%. We're talking about APR again, annual percentage rate. Again, not like credit cards. So that means that if you do 5% APR, annual percentage rate, you divide that by 365 days, right? Just like on a mortgage, it's 12 months. So here it's 365 days. That'll be 0.137% of daily interest. People, daily, right? Interest. So that means that lender will apply that 0.137% of your principal every day. Every day. Mortgages are front loaded within the year until the monthly payment, right? So that means that on a $10,000 principal loan, it will be approximately $1.37 a day, right? $1.37 a day. So day one, it'll be $1.37. Day two, $1.37, etc., etc. Day three, the same thing. So at the end of that month, your total paid interest will be $41 and like 10 cents for the month on that student loan, right? On that $10,000 student loan, right? Sunny boom of the South, Jackson State. Yeah, I'm so excited about that on Wednesday. And so month one, let's say if you have a monthly payment of $150, right? You're paying $150, so it's $10,000 a month. And a lot of people ask me, would you use student loan to buy a house? I mean, both of them, I don't like either one of these loans set up, right? So just know if you do use student loan to buy a house, you're going to get charged daily interest. So know how to calculate your APR, right? And know how much your daily interest is going to convert into your monthly interest. So let's say you make $150, right? But only $108.90 is going towards the principal. And what did I tell you all or educate you all the principal was? The principal is the actual amount that you actually borrow. The amount that you actually borrow. And so, by the end of the year, Your balance total on a $10,000 loan at this 0.5% interest rate would be $8,777.18, right? If the loan doesn't have any prepayment penalties. You can pay it off faster by making higher payments every month or paying towards the principal every month. Because a lower principal amount means that the daily compounding interest, right, will be smaller. Same thing with a house. The lower principal amount, the lower your monthly interest, right, will be. And apply to small numbers. So just sometimes paying an extra $10 or $12 can give you big gains over the life of the loan versus paying $100 or more towards the loan. Just paying $20 towards the principal of the loan will be more than just paying $100 toward the loans, because if you're just sending extra payments, you're not tackling the principal, right? You want to tackle the principal. The principal, again, the original amount that you borrowed. The interest rate is the cancer, right? If you just go back and watch the beginning of this video when I kind of explain, I don't have a program or anything set up for velocity banking. Like I say, I usually don't have the time because I get so many people with credit. So let's say if so many credit clients. So if you have accumulated $41.10 in interest during the first month of your loan and don't make a payment, your principal can be increased to from $10,000 to $10,041.10, right? And then after that, the daily compounding rate will be applied to the new principal, which means you're being charged interest on the interest. I'm gonna say that again. I'm gonna type it in. So a lot of people that get these student loans in deferment, this is where they end up. They defer their student loans, right? And they don't make any payment. Let me see if I want to put it. And then after they don't make any payment, right, they get daily compounded interest that's applied to your new principal. And this is why deferment is so deadly and not making any payment. Now, this is what is called the rule of 72. Albert Einstein educated on this, where your money is supposed to be accumulating compounding interest, meaning that you get money on the interest, right, that you invested. That's the rule of 72 by Albert Einstein. Let's see if I can pull it up. But student loans often do the reversal. Student loans, when people go into deferment and let me share this with you, and they don't pay, then their principal begins to accumulate interest, and then that daily interest, right, then begins to pile up on that interest. It's how to makes that money, and that's why a lot of people get nowhere with, I can't pull it up. That's why they get nowhere with student loans. Okay, here's a great picture I want to share with you. That's why they get nowhere with student loans. Because they go into deferment, or they pay the minimum, or they get on the, what is it called? Income-based plan, or they get on the income-based repayment plan, or what's the other one called? But then they begin just to make the minimum payment, which tackles nothing. And then that loan is compounding in interest, which means that not only are you getting interest charged daily on the principal balance, right? But now you're getting interest charged on the interest. People. And the worst thing about student loans is you can't discharge it in bankruptcy. So the rule of 72 came from Albert Einstein, and it states you take the number 72 and divide it by the annual rate of interest that your money is earning to determine the number of years it would take for your money to double. Right? Exactly. Interest rate is the cancer. And just like any disease or health impediment, if you, just like a cold, for example, with a cold, you can only treat the symptoms, right? There's no cure for the common cold. You can only treat the symptoms. However, if you get more an advanced sickness like the flu or pneumonia, right, or cancer, you have to get to the core issue of the problem. And you have to treat the problem. If you can never get to the core of your principle, right? Because in this case, the cancer builds up on the outside, which is the interest rates. And that's why I tell people all the time, interest rates are simply interesting. Because thank you so much, Lady Lou, for the $4.99 super chat and support. Interest rates are only interesting because if you pay off a high principal loan in a shorter period of time, you will pay back less interest than you would a low interest loan over a longer period of time. Do I need to say that again for the people in the back row? I'm going to say it again. If you pay back a higher interest, right, loan over a shorter period of time, you will pay back less interest rates than you would a lower interest loan over a longer period of time. You will pay back double the amount of interest. I just broke that down to you in the mortgage. A $250,000 mortgage at 3% interest rate over 30 years, you'll pay back $750,000. Right? And so velocity banking only works if you have the credit. It's a good philosophy, but if you're not positioned credit wise and cash flow, then it can't apply to you. Because what'll happen is if you don't have the positive cash flow and you can't get approved for the high interest credit cards or the lines of credit, and if your cash flow is steady or negative, you're going to default sooner or later. You need the positive cash flow, and this is where the home-based business come into play. This is what the other people that teaches velocity banking don't help you do. They can't help you get $200 to $600 out of your paycheck. And a lot of people need that just to make this work. Because the lines of credit and credit cards must be paid, right? I call it paycheck parking. I do recommend you dump your paychecks in the lines of credit, But that home mortgage note still have to be paid as well. And if you are right at breaking even with your cash flow every month, or your cash flow negative, then it won't work for you. If your credit is bad, it won't work for you. So a lot of people that teach velocity banking, if they can't position you credit wise, then it's just knowledge for you, but it can't ever be applied knowledge. See, Jim Rohn said that applied knowledge is power, right? Applied knowledge. So your credit has to be in position, especially when it comes to the mortgages. Get your homeowner's insurance raised down with a higher credit score. Your cash flow has to be in position. I help you through a home-based business, get that extra cash flow that you need out of your paycheck so you won't be struggling to implement these methods. And with student loans, same things. You have to tackle the interest, but I just want to show you how the calculation on a student loan is daily versus your mortgage, which is calculated in the front. Both of them are amortization, but it's just amortization done differently. And with a student loan, is even more deadly because you can get charged interest on the interest, right? So hey, you all, this has been almost a 2-hour live stream. I hope this helped you all. If you didn't watch the beginning of it, too, also some information about what's better, your income or your credit score for credit funding. But just know the foundation of all of this is credit, right? Live the good credit lifestyle. Make sure you subscribe to my channel. Follow me. And hey, this is to your peace and prosperity, your credit and your cash flow, your health and your wealth. Queen of Credit out. Thanks for everyone that donated to the channel. I really enjoyed this teaching and I hope it helped you as well. Let me read this last. Someone said sounds like that. 12G. I just took out my 401k. Should have put to on my principal. I did pay my car off. You paid your credit cards off with your 401k? Let me sip some water on that. I don't know if I would have paid my credit cards out of my 401k. And this is why. You all, if push ever comes to shove, paying off your credit cards will give you a higher credit score, right? It will free up cash flow. That's a minimum payment. But with credit card debt, only 2% of the balance is due. And this is a whole nother live stream. But I don't know. You said 12,000. I understand. Okay. Maybe I don't know. I'm not looking at your situation, right? I'm not looking at your situation. But I hope the credit cards that you paid off are credit cards that you can still recycle and reuse for this economy. I hope you didn't close the lines of credit. I hope you didn't cut them up. I hope it freed you up a lot of cash flow for making that move, right? Because credit card debt can be sold. Did you all know that? I'm glad I stayed on. I got another $5 super chat. I will check my IG. Let me check it now. Credit card debt can be sold. See, when these big businesses get into bankruptcy and et cetera, let me show you all something else. This is how you make money in your sleep. I just got a text message from my home-based business. Let me turn this. See, I think you can see it. I just received $90-some. These are my deposits from my home-based business. This is what you call passive income, and I earn income. Another deposit. Wednesday was $785. Tonight is $73, right? Passive and making money while I'm talking. Oh, I'm supposed to check Instagram. But credit card debt can be sold. And what I mean by that is you can discharge credit card debt in bankruptcy. Is this Mr. Wheeler? I think I asked you that. Justin Wheeler told me to check my IG. Is this you? Okay. And I tell people all the time, you know, it can be discharged. Sometimes you can negotiate for less than what you owe. You can discharge credit card debt in bankruptcy. A lot of people don't want that you know, bankruptcy on their credit report for up to 10 years, right? But I don't know about that advice of taking your 401k and paying our credit card debt. I just don't know about that, right? Some people saying they're getting more cash flow. I did $50,000. But how long are you going to have to work? All right, you can get more cash flow for not paying debts. But now, because did you all know, for example, if you, let's say you have a $50,000 gross income. it's going to take you about $500,000 to retire. That's how you add up your retirement. So now what's your, and I'm not saying to keep your money to a 401k, right? And which, especially if you're losing money, 401ks is set up so you can lose money. People are losing money into their 401ks. But I hope the credit cards that you paid off, you still can recycle and reuse. I don't know. It's just hard because I don't know your situation. But sometimes I wish if you're going to pull money out your 401k, invest it in something that can get you cash flow and higher rate of return versus paying off debts that can be easily discharged in bankruptcy or through negotiation. Then you can get new credit cards, right? And build your score back up. But let's say if you would have took that money and invested in a rental property or real estate or home-based business, with a home-based business only 228. So that's a real low investment so you can get passive income. See, the only way to pulling out your 401k and paying out credit card debt creates cash flow for you is that your job is secure. And your job is not secure. No one's job is secure in this economy. No one. Not in the middle class sector. Even corporations and CEOs, right, are laying off people because they're saying they're understanding that it's more, they can save more money to have people work from home and they don't need these big positions, right? And so many layoffs are going on. So if real estate is about to be the cheapest that it's ever been in years, that's just one. Or maybe converting into physical gold and silver. I think the spot price for silver right now is $30 an ounce. However, if your job is secure and you didn't want to discharge that credit card debt that way, because maybe you're concerned about your credit, then I understand making that move. So hello. Okay, so the job is letting her work from home. Someone says you can take a 401k loan to buy property, get an equity loan based off the ARV or the property, pay back the 401k out of it and come out with property. Right. I don't trust 401ks anyway. Pensions, none of that, because it's all controlled by the feds. When they get ready to pump or dump the market, then it's all affected. So having your 401k and tangible assets is great. But hey, again, if your job is dependable, right? And let's say paying off your credit card debt frees you up $300 a month of cash flow. It's going to take you approximately almost 3 years to get that 12K back for $300 a month, right? Because at that rate, you're saving $3,600 a year. So that's $7,200 over 2 years. So approximately 3 years. If that saved you $300 of cash flow, it's going to take you 3 years to get that money back. All right, someone said, so, that's what I'm saying. Would you came out on top had you invested it? And maybe a property or multi-unit that's going bankruptcy during this, pandemic. Right. Paying yourself back. It's just, someone says they need credit help. Go to my website, fixmycreditandcash.com. Go to credit help. And it's $125 investment. Some people ask me sometimes, what do I get for the $125? First, you get a customized plan of action of what you need to do to raise your credit score at the highest standard, right? That is a detailed report. Second of all, if you enroll with me as a client, you'll also get a quote to work with me to fix those problems with you and for you. And if you enroll with me as a client, that $125 will be applied towards the price in the way of getting your credit and addresses removed and deleted. A lot of people don't know those are extra points added to your credit score, and it gives your credit profile a very clean credit profile. No credit reporting business does that. You won't get that with a credit reporting business. You get that with me. So that $125 is applied towards those services, which is usually $125 or more services when done separately, right? And so that's how that credit analysis work. That's what you're investing in. You get the quote, you get the game plan. Listen, if you don't want me to help you to do the work for you, at least you have the game plan, right? You know what has to be done. You might want to try to do it yourself or maybe go with someone else, but at least you know, right? Because what a lot of people think is going to help them improve their credit score and get them their credit to the highest standard is not what they have to do. You have some people that dispute things that are no longer even calculating that credit score that shouldn't be disputed, right? And so that's what the credit analysis entail. Again, go to the website, fixmycreditandcash.com, credit help. Also, if you're looking for tangible assets, silver, you can get that silver stacking report on my website as well. A very small investment of $35. If you don't know about silver, then, one of my recent videos I did is called US Debt Clock. Silver projected, it was $4,000 and cash per ounce of silver printed. Gold was about 30,000. And so silver is predicted to be a great return on your investment as well. A great way to convert cash or currency into real money and physical money. Jesus says we need 16 more people to hit the like button, please. Jimbo says it's good too because you're using that money, using their money because 401k matches your money. So you're using some 401ks matches. They'll match you dollar for dollar. But when that stock crashes, they're going to take it back. They're going to take it right back. Unless you take that 401k and take it out of the stock market and move it to a savings account. And yeah, 401k is just another tool to steal people's retirement. And so, I don't know. I don't like to give people financial advice, but that's why I introduce people to the home-based business and I just educate people. 90% of people have negative debt and cash flow. If you're going to pull money to retirement, at least use some portion of that to position yourself to get assets. A home-based business is an asset as well, right? Home-based business is an asset as well. And this home-based business help people in areas that they need help. It's service-based. It's not product-based, right? It's service-based. It's not product-based. What do I mean by that? Product-based businesses, you have a competition. Like if I'm selling weight loss products, I may can go to Walmart and get, or CVS, right? And get weight loss tea and products as well. Service-based is helping people during a recession in the 4 areas of their financial life, right? So do I, like having to do the home-based business alone? No, I don't like it, but I learned to like it because it's a need service business. It's providing water in a desert. Everyone during this economic time is going to need this home-based business. Even the federal employees that have no choice but to get their payroll tax out of their paychecks at 6.2%. And then at the beginning of the next year, their paycheck is going to be 12.4% less. See, it helps them get that money back out of their paycheck, and that's dropping 12.4%. And this is a whole nother thing. But see, people don't understand the factors that's still in their paychecks. You have FICO, which is Social Security and Medicaid, right? You have federal taxes. Some cases you have state taxes, and then you have your insurances. So you only bring home 30 to 40% of your paycheck. The home-based business have strategies and systems to get you that money back because they add the tax deductions. So you're taxed less, which means you can bring home more. So it helps you with your taxes, helps you with your credit management and your debt, and it helps to combat inflation, right? So in the home-based business, as we're on this as well, people are also converting their 401ks into our land banking account, another tangible asset. Not gonna go into detail about this. I talk about it. It's out of Antelope, California. You can have purchased land in the path of growth, right? Similar to Silicon Valley, the technology, Green Valley, Green Valley, California, right? But this Antelope, California, Warren Buffett is investing in. The Olympics is coming. It's in the pathway of land and growth. If you want to get in that financially positioned during this recession, right? Real estate, coins, silver, gold is about 2,000 plus an ounce right now. So silver is more affordable. And, right, cryptocurrency and business income. That's it. Dave Ramsey and Sue's Army only provide the problems. I'm providing solutions. So you have to understand supply and demand, right? You have to sell ice in the summer and wood in the winter. Other than that, I tell people, what other options do you have? You know, does that make sense? What other options do people have? We are in a recession. People need problems. Thank you. They need answers to problems. No second jobs out there. People going to need credit. It's too many advantages of using credit cards over debit cards. People need cash flow, right? And it's very affordable. So also, you want information about the home-based business and get your financial education and position yourself, go to fixmycreditandcash.com. Again, it's a tab up top that says home-based business, where you can actually position yourself to apply some of these principles, create cash flow and time, and get real assets, right? Real assets. All right, you all, this is to your peace and prosperity, your health and your wealth, your credit and your cash flow. Queen of Credit out. See you all next on my live stream. Make sure that you subscribe. Make sure that you subscribe because I pop up live at any time. Always impromptu. So subscribe. And right next to the subscription button, hit that bell notification button so you can know when I'm live. Have a great night.